In this video, we will see the latest update from Robert Vinall from RV Capital. You see that as of Q3 2024, his portfolio was pretty active. And if you click on activity here, you see that every quarter you have some activity. So this is a website called Dataroma where you can check all the super investors portfolio. And let's start with the first position, Carvana, which he reduced a little bit. Carvana is the biggest position in his portfolio, 27% of his portfolio. And in case you don't know what Carvana is, that is e-commerce for cars. And the company has skyrocketed during the pandemic 2020, 2021, as you can see here, and then crashed 99%. And I remember Robert Vinall assessing the situation, explaining what went wrong about Carvana. Apparently, management did a lot of heavy investments, thinking that the environment for their industry would be fine, but it was a double-edged sword. So it means that all the heavy reinvestments worsen the global situation for the company. So the company was in a terrible shape in 2022, and then everything rebounded sharply. And if you had invested here at, $5 per share, you would have made a lot of money. Year to date, the performance is 400%. And if you look at the past 3 years, that has been a bumpy ride. So yeah, this is about a turnaround story, and it seems to be working well for Rob Vinall. I suppose he has not bought a meaningful stake in the company, but the stock has gone up so much that now it's set in 27% of his portfolio. So maybe he's taking some chips off the table. And if you look at the financials for Carvana, this is not a company that generates a lot of free cash flow, a lot of money. This is a e-commerce company for cars, so we are not the highest margins ever. You see that the revenue is having this peak revenue in 2021, and now you have a rebound sharply. Same thing for the net income. That's a mess if you look at it this way. So this is purely qualitative here. You do a bet about the growth and about the future of the company with extremely strong potential if it works out. But for the moment, the company has a lot of debt, is not that profitable. So wait and see. And maybe Rob Vinall is assessing the risks and reducing a little bit his stake. The second one is Meta Platforms. So Facebook, very famous company, very profitable company, reducing a little bit. I suspect that it's because of the recent run-up from the company. He bought the stock a few years ago, and the stock went up and up and up, and now you have a price for Meta Platforms of $600. You are at all-time highs, but this is a safe company with a driven CEO. You have a reduction of 20%. That's fine if he finds better opportunities. I think that is the case for Robert Vinall. He doesn't want to sell everything. He just wants to allocate to better opportunities with better risk-reward performance. Now the third position is Wix. It's a website where you can create other websites, a company from Israel, and 13% of allocation, no change at all. The fourth one is Credit Acceptance, that he trimmed a little bit, 2%. Credit Acceptance is about auto cars, I think. And absolutely no move. Minus 2% is almost nothing. Same thing for Interactive Broker, one of the best brokers out there, and plus 2%, so no meaningful change here. Same thing for Pinduoduo, the Chinese giant, almost zero change. And what is interesting is that there is one new bet in China, Yum China Holding. If you check on Google Focus here, Yum China Holdings, you can ask, what is this business? Here is the stock chart for the past 10 years. What do they do? And why do you increase substantially your bet on China? That's a very interesting situation. Rob Vinall I read all his letters. He is bullish on China long term. He had invested in the past in many Chinese equities. And let's look at Yum China Holdings. This is a company with a market cap of, let's say, $20 billion. Okay. They have Yum China is the largest restaurant chain in China. It generates revenue through its own restaurants and franchise fees. Key concepts include KFC, Pizza Hut, but the company's portfolio also includes other brands such as Little Sheep, East Downing, Taco Bell, and other Chinese names that I won't dare to pronounce. Okay, so a small conglomerate, 20 billion market cap of different restaurant brands. And if you look at the financials for the company, you take a look at the revenue, slightly increasing, net income slightly increasing up and to the right. What about the debt? They don't have major cash, major debt problem. And what about the free cash flow that the company generates? Slightly increasing. And here we go, you have the return on invested capital that decreased in 2020, 2021, and now that is rebounded. The company does a lot of those small buybacks, like 2%, 3% per year. That's decent. Okay, so what does Rob Vinall sees in this stock? If you look at the quarterly measure, quarterly metrics, no big improvement here. Small buybacks here and there. Okay, so the company increased buybacks 1 year ago. The company still generates reasonable free cash flow. You have free cash flow of 250 million per quarter, so that's 1 billion per year. So because of the market cap is 18 billion, I suspect you have a price to free cash flow of 18 billion. Price to free cash flow of 28. Oh yeah, you need to adjust because it went down the past in 2023. PE of 20. You have a reasonable valuation for a restaurant chain in China. So no major financial improvement for Yum brand. So I suspect this is that could be a macro bet, thinking that the consumer sentiment will improve in China. You do your own due diligence if you want to go deeper, but that could be something interesting. And the company is getting more efficient, improving the return on invested capital over time. Okay, very well. And the stock has derated significantly, has crashed significantly. Okay, interesting. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Next one, that's a 5% position. Okay, that's decent, but that's still a small position. H World Group. What is that? HTHT. That's the first time I learn about this stock. This is also a company in China. So Rob Vinall significantly increases his position in China. What is the stock chart looking like? You have this. The stock has done nothing for the past 7 years. Very well. What do? H World Group is a multi-brand hotel group in China. Okay, so Yum brand, that was restaurants, now that's hotels, and they have chains in China. Okay, very well. So same thing. Maybe this is a bet on the macro level for the consumer in China. So maybe this will improve. And what about the financials of the company? Revenue is going up sharply. Net income is a mess. Oh, they burnt money for 2020, 2021, 2022, and now maybe there is a comeback to reality. The company has a lot of debt. You have net debt of, let's say, $4 billion compared to market cap of $11 billion. Okay, so sizable debt, not a major issue, but sizable debt. And the company now is coming back to life with some strong cash flow generation. If you look at the quarterly basis, maybe you have a change, a pickup in demand. Yes, a little bit. What about net income? Yes, a small pickup in demand. I mean, you come from a horrible 2022, so it's easy to beat this past year. And the free cash flow, same thing. And some buybacks here and there. And the return on invested capital is below 10%. So we are not talking about an extremely good quality company, but a decent company, restaurant chain, and I don't see a major quality shift here. So again, do your own due diligence. Price to free cash flow of 15, PE ratio of, let's say 15, 20, with a stock that has gone nowhere for the past 7 years. So maybe there will be a pickup in demand for China, and obviously restaurant chains and hotel chains will benefit. So now you have 5% and 5%. That's a 10% allocation to China. and you have Pinduoduo at 9%. So you have 19% allocation to China for Rob Vinall. And then we are talking about tiny positions, so Deere & Co, so no change for this one. Paycom Software, which is quite new, but this is insignificant. And Salesforce. If you want to check what Paycom Software does, this is a tiny position, so I suppose he just wants to start and then investigate what the company does. Let me check what the company does and any financials, so you leave this video with a lot of value. Okay, this is a market cap of $13 billion. So we are not talking about small caps. That's mid cap, large cap. We are not talking about small companies. PE ratio of 27. What do they do? Paycom is a fast-growing provider of payroll and human capital management software, primarily targeting clients with this amount of employees in the US. Okay, so gross margins, obviously, margins are high because this is a software business. PE ratio of 27. And can I see the financials for the company? I suppose we will have the same scenario of the stock price going nowhere for the past few years. That's the style of investing. Yes, wow, that's a major crash. If you look at the past 10 years for the stock price, we are back to 2019 levels. Wow, that's a major crash. And below high, I mean, the stock is down 60% since all-time high. So yeah, you can get these stocks for cheap. And look at the financials. This is the revenue up and to the right. That's very good, very healthy. Net income, same thing. Free cash flow, same thing, increasing year over year. And you have, seems like they have no debt and some cash here and there, but nothing big. The return on invested capital is not that high, it's 10%, and now they do some buybacks. I'm curious to understand why the stock crashed so much. If you look at the revenue, it's quite stable when the stock price crashed. If you look at the net income, well, I don't know how to read this one. I don't see a major crash here. Same thing for the free cash flow. So I suppose there was a scare about the quality of the industry. Maybe AI, maybe something else, maybe some change, maybe some governance change, but there was definitely a change in 2022. And the stock seems cheap at the moment. You have a PE ratio of 27, but we are talking about a software company that will continue to improve over time. So a PE of 27 can change into a PE of 25 and then reduce to 22, 20. That's decent. I would not say this is screaming cheap, but you get my point. This is not overvalued. Okay, very well. And that was the update for Q3 2024 for Robert Vinall. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.